Oh, well, good morning, and thanks for joining us this morning for our Division 296 SMSF expert webinar. I'm going to be your presenter this morning. So just to give you a quick recap on how we've gotten to here. So the Division 296, if you remember, has been 3 years in the making. The original legislation that we had was awful, and we accountants, we did not like it at all. The two things we did not like was that it taxed unrealised gains and also that it wasn't indexed. So 3 years later, here we are, and we've gotten over those two hurdles. So we're only taxing realised gains, and we have got some indexation. So I'm here today, going to present this to you. I have listened to 2 days worth of Division 296, and I've read books worth of material, so I can distill it all down for you and make it very, very simple and only tell you the things that you need to know and make it very simple. So it's coming in on the 1st of July 2026, so coming up. However, the balances will only be assessed on the 30th of June 2027, so we've still got a year. But there are some things, there's some crucial decisions that you need to make before the 30th of June, and that's why we're doing this today. So it's great that you're here joining me. Now, just a couple of housekeeping things before we get started. Jane is here to handle any technical issues. If we have any problems with the sound, we'll try and get them sorted as soon as possible. Hopefully you have a nice cup of tea, coffee to enjoy. You can settle down and listen to this webinar. Hopefully you won't need anything stronger. Also, very important, if you have, I'm going to try and stop after each section and answer any questions, which is a bit different to what I usually do. I usually just have questions and answers at the end. So if you've got any questions, pop them in the question and answer, which is down the bottom for you, not in the chat. Pop them in the questions and answers, and I'll answer them as I go along. I'll take a break and I'll answer the questions and answers. So before we get started, my quick disclaimer, everything I present today, it's not personal advice. I haven't taken into account your personal circumstances or objectives. It's general information only. So do not sue me. Everyone on here, I'm sure, are my clients. However, we do have a couple of guests. So if I haven't met you before, I'm Susan. I have won some industry awards in the SMSF area, and I've also been a guest speaker in the SMSF topics. So very nice to meet you this morning, and thank you for joining us. Okay, so let's chat. How did we get here? It's very important in this environment that we talk about what's happened with the budget, because we want to get a picture of where we're sitting and why super and the framework around super is so important. So if you were living under a rock and you missed the budget, let's talk about it. So I've been doing this a very long time, but that budget was an absolute shocker. So what we saw happen in the budget, the government has removed the 50% discount, the CGT discount on capital gains. They have removed negative gearing, except on new builds, except that it is grandfathered for existing property. And because of their treatment of trusts going forward, their intention is basically to have a minimum 30% tax. So if you look behind the intention, it's to have you paying 30% tax no matter what you do. So when you're making a capital gain, the intention is that you make a 30% tax. Now, this is very important when we also take into account what happened with super, because nothing happened with super in the budget. So there was no change to the CGT discount in super in the budget. So there is still a 1/3 CGT discount. There was no change to negative gearing in an SMSF, although, I mean, we wouldn't want to be negative gearing in an SMSF. And when we look at the tax rates in an SMSF, they are either 15%, 10% if you make a capital gain, or 0 if you're in pension phase. So when we look at the intention to have a 30% tax, the tax in an SMSF is just at such a low rate. And so what you should be thinking is it's just a no-brainer now. The lowest tax entity, the government has officially made the lowest tax entity an SMSF. And so strategically, you should be thinking, how can I move my assets into an SMSF to build wealth? It becomes a choice of, do you want to leave your assets outside of super and give a chunk of that in tax to the government? You're going to pay a minimum of 30%, up to 47% at your marginal rate. Or do you want to build that wealth in super and pay a very low rate, like I've said, 15%, 10%, or 0? So in my way of thinking, it becomes a no-brainer. Now, what assets can we move into super? Of course, we can move cash. We can move, the other assets we can move are listed shares on an approved stock exchange, and we can move business real property, which we know is commercial property. So we can move those assets in, subject to the limits. So we've got our limits of contributions. So super becomes a really good environment to grow wealth in. Now, this is our starting point of the Division 296 tax, because Division 96 has been known as this 30% tax, but as I'm going to show you today, it's far from a 30% tax. It's actually an additional 15% on monies over 3 million, and then an extra 10% on money over 10 million. But as I'll show you today, it's far below 15%. It doesn't even work out to be 15%, and then it doesn't even work out to be 10%. So to get to 30%, when we look at where we've got these, when I've got the slide up and we've got the minimum of 30% tax outside of super, to get to that 30% inside of super is actually very difficult. You have to have a lot of wealth accumulated in super, and it's got to be all not in pension phase, and we'll work through that today. But that's our starting point. So hopefully that's all made sense. Okay, so let's kick it off. So Division 296, how much tax do I pay? So we've got, they love a good acronym. So we've got these acronyms. We've got what they've called, very creative, they've called it a large super balance and a very large super balance. So large super balance is the 3 million threshold, and then we've got the very large super balance, which is the $10 million threshold. That should be BL. Thresholds are going to be indexed to CPI, which is what we asked for. So they'll both be incrementally indexed. So not stuck at the 3 million and not stuck at the 10 million. Now there's the two tax rates. So 15% where the total super balance is greater than 3 million, and then an additional, the total super balance is greater than 10 million. But like I'll show you, it's a proportion of 15% and it's a proportion of 10%. So it's not necessarily the whole of 15%. So when is your members balance tested for this Division 296? Well, it's coming in on the 30th of June 2027. So not 2026, just coming up, 2027, which means we've got a whole year to sort our balances out. So for the first year only, if the member has less than 3 million at the 30th of June 2027, no Division 296 is payable, even if you started the year with a much higher balance. So for example, if you started, if at 30th of June 2026, you've got 4 million, but at the 30th of June 2027, you've got less than 3 million, you're not going to pay any Division 296 tax. So if you withdraw your benefits ahead of 30th of June 2027, there's no add back. So it's a very simple calculation. That's for the first year only. In future years, however, it's going to be based on the higher of either the opening or the closing year. So if it's 4 million one year and 5 million the next year, then it's going to be based on the 5 million. It's just whatever is the highest balance. So it's very simple. It's designed to ensure that going forward, it can't be avoided by withdrawals prior to the end of the year. So they simply take whatever was the higher balance. It does mean, however, that you basically, if your balance is above the 3 million, you will get caught out for 2 financial years. So if we look at this example, on the 30th of June 2029, this member's balance was 4 million, and yet the 2 prior years they were under 3 million. But it will take, so for the first 2 years, it will take the higher balance, and for the next 2 years, it will also take the higher balance. So it will take either the opening or the closing balance, whichever is the highest. So you will get caught out for both years. But I suppose the only advantage is in the simplicity. So if we look at an example, here Teresa has a TSB, a total super balance of 8 million. The formula itself is very simple. It's just 8 million minus 3 million over 8 million gives her a proportion of 62.5%. So 15% tax times 62.5% times her Division 296 earnings. Now, if you have a look at the graph, under 3 million, she pays nil Division 296 tax. Up to 15% tax, the proportion above 3 million, she will pay a 15% tax, and the proportion above 10 million, she'll pay the extra 10% tax. If you have a look at the calculation, she ends up paying not 15%, but 62.5% of 15%. So she doesn't even pay the full 15%. So I hope that makes sense. So in effect, all you need to remember is it works out to be less than 15%. You have to have accumulated a lot of wealth for you to even pay 15%. Now, the other important thing to remember is the Division 296 and the amounts that you have in pension phase run alongside each other. So it's possible that a client can have amounts that have grown in pension phase that will pay absolutely no tax. And then this Division 296, they will pay tax on that money. So it's not, that's what I'm saying, it's not necessarily that they're going to pay 30% tax. They may have that whole amount where they pay no tax because it's all in pension phase. And then, like Teresa, they may only pay a proportion of the 15% on the amount that's over 3 million. So as you can see, it doesn't work out anywhere near 30%. So Teresa will actually end up paying 62.5% of 15%. And if we have a look at the next example for Joe, where he's got 12 million, he's still only paying 75% of 15%, so still not even 15%. And then he pays 16.67% of 10%. So there's still not even the full amounts of the 15% and the 10% tax, and he's at 12 million. And depending on what amounts he has in pension phase, he can still be exempt from tax on those amounts. So if we go back, oh, sorry. Sorry, I may need some assistance from Jane to go back. It's going the wrong way. Hold on, I just need my trusty assistant. I'm trying to go back in the slides and it's going forward. Just go back. Sorry, yes, sorry, this one. Sorry, I needed my trusty assistant there. So if we go back to this, where if you have a look at the calculation and it's saying we're working out how much of the 15% tax we're going to pay, and it's always saying of Division 296 earnings. Now, what is the Division 296 earnings and how do we calculate that? So we're kind of thinking that it's the earnings of the fund, which is true. Of the fund. Well, let's have a look. So the 96 will be the capital gains, including the discount. So we are still allowed to apply the discount. In this way, the capital gains, when we calculate for Division 296, may differ from the capital gains that we pay tax on in terms of the fund's income. Because if you remember, if a client is in pension phase, all capital gains and capital losses are disregarded. However, once we come to Division 296, we need to calculate those capital gains and capital losses for the purposes of Division 296. So we may end up with two different amounts. Next item of income, dividends, distributions, interest, and rent is all included. Franking credits is included. Assessable super contribution
super contributions is included in terms of the fund's income.
Pay 15% tax in terms of the fund's income, but we don't include it again in terms of Division 296. So it's not included, it's not counted again. That makes sense. So we've already paid 15% tax, so it's not included again. Exempt pension income is included in the fund's tax return, or in that we get an exemption for it, but it just makes up normal income in terms of Division 296. And of course, we get our deductions. So in essence, the income for our funds tax return will also be the same as Division 296, except that the capital gains, there might be slightly different treatment. Of course, you know, if we were in pension phase, we're not going to include that income, but we are when we do Division 296. And of course, super contributions, we're only going to pay 15% tax. We're not going to then double count that and pay extra tax. So this is this is the key thing that you guys have to remember for this webinar. This is the only thing you get out of it. So regardless, if you are over 3 million, everybody gets the opportunity to make a cost-based adjustment. Now, I don't know how many of you were around in 2017, but the same thing happened for select clients. We're given the opportunity to make what was called a cost-based reset. Now, this is exactly the same. It's basically a cost-based reset, but because they've already done that once, that's why they're not calling it a cost-based reset. They're using different terminology and calling it a cost-based adjustment, but it's basically a cost-based reset. So because they're only taxing realised gains, not unrealised gains, what they're saying is if you say you have a property that you bought for 500,000 and it's now grown to $1 million, and then after the 30th of June 2026, or after the 1st of July 2026, when this legislation comes in, you sell it for 1.1 million. It's not really fair if all of that gain is then taxed. So they're giving you the opportunity to reset the cost base to the market value on the 30th of June 2026, so that you only have to pay tax on the gain you make from that day. So that makes it fair. So does that make sense? Now, this is only for Division 296 purposes. It does not change the cost base in terms of your normal SMSF capital gains calculations. So we're going to have two cost bases in the financial statements. Yay, yay for us accountants. Now, important things to note. It is an opt-in. So you have to opt in, and it is irrevocable. So you can't change your mind once you've done it. It's for SMSFs only. So other super funds, retail and industry funds don't get this option. So it's only for SMSFs. Now, all funds are eligible, even funds where the member's TSB is under 3 million. And the cost base of all your assets held at the 30th of June need to be adjusted to market value on the 30th of June 2026, and it's only for Division 296 tax purposes only. So the key points out of that, you have to adjust all your assets. You can't cherry pick out assets that you want to adjust. Now, where it might not be useful, say you have, let's use property again. Say you have a property, or say you have shares. Say you have shares that you bought for 500,000. They've gone down to 250,000. So because you've got a whole lot of different assets, you reset the cost base to 250,000 at the 30th of June. And then they increase in value after that to $1 million. You're going to make even more of a capital gain, which is not going to be to your advantage. So you have to think quite strategically about this. I would say it's going to be really beneficial for those of you who have property, even if you're under the 3 mil, to reset the cost base in case it does grow in the future. Just because property is growing so exponentially, and if you're holding it long term. If you have share portfolios, it is going to be quite difficult because you don't want to be in the situation where you're resetting the cost base down and then you're making even more of a capital gain. Unless you want to go through your portfolio before the 30th of June and tidy it up, where you're getting rid of those non-performing ones so that you can adjust all of them to the 30th of June. And the other thing is valuations are going to be key at the 30th of June, especially if you have assets like property. So if you've got an asset like property, you want to get a really good valuation at the 30th of June because you want to optimize the value at the 30th of June 2026, meaning, the higher the value at the 30th of June 2026, and then obviously when you sell it, you want the value at the 30th of June 2026 to be the highest value. So, it tends to be the more comprehensive the valuation that you have done, the better the valuation is going to be. So they're the key points out of that. It's an opportunity for everyone, no matter whether your fund is less than 3 million. So everyone has that opportunity. You need to think strategically about it, what you're going to do. This is why we're having this webinar today, because you only have until the 30th of June just to make the decision about what assets you're going to reset. That's all you have to do. Now, the actual election does not have to be made until you lodge your 26-27 tax return, which will not be due until May 2018. So that's a long way away. So actually making the election is a long way away. So you don't have to make that decision. But the things that you do before the 30th of June 2026 will be crucial. So the things are, getting the market value and cleaning up your balance sheet and deciding which assets you may reset. What was the other thing I was going to say? No, it's gone. Thought bubble is gone. Yeah, so they're the key things just to have in place. Now, if you don't get anything else out of this webinar, this is what you need to do and just focus on. Oh, I know what I was going to say. The ATO has not even given us the approved form. They've told us we have to do this. We have to make this election. It's opt-in. It's irrevocable. But they haven't given us this form, so we have no idea what it looks like. So we don't even know. So we probably won't get that for another year or so. but we do know that this is going to happen. Okay, so, right. So going back to the Division 296 earnings that we were talking about, which is basically the earnings of the fund, where we've got more than one member. So we might have one member who's over 3 mil, and we might have one member who's way under 3 mil, which is very common when we've got husband and wife. So how do we work out, you know, the member who's going to be paying extra tax, how much of the earnings belong to them? Well, it's basically just going to work exactly the same as what we do at the moment with actuarial certificates. So it's going to be on a weighted average basis, and we're going to get an actuarial certificate. So just like the current process, we will basically organise the actuarial certificate as part of our process that we do. How will the assessment of the Division 296 work? Well, just let me check the time. Great. So the super fund will basically report your, as in us, as in the SMSF accountant. So we will report the members' balances to the ATO, and I suspect that that will be just part of our standard process when we lodge the tax return. The ATO will then identify any members with TSB over 3 million, and they will come back to us, as in the accountant for your SMSF, and they will ask us to calculate the fund earnings. So we will calculate those fund earnings and send it through to the ATO, and the ATO will then issue a Division 296 assessment. And that will look very like, for those of you who get a Division 293 assessment, that will look very like that. Now, the other thing to note is Division 296 assessments will also be issued. They're not issued to the fund. It's not something that the fund is liable for. It's actually a personal tax on the member. So the member actually is personally liable for it. So the process is much like a Division 293 if you've had one of those. So in terms of the Division 296 tax assessments, the first assessments are not expected until 27-28. And this is important too. The liability is on the individual or their estate. So if someone passes away, the estate is assessed for the Division 296. And this is important because what quite often happens is if you have a binding death benefit nomination, you can nominate, for example, your children. So your children may receive all of the benefits of your estate. Say you have over $3 million. Say you got $4 million. You might give them $2 million each. And then the estate, who hasn't actually received anything, is going to cop a Division 296 assessment. And what are they going to pay that out of when they haven't actually received anything? So that's worth bearing in mind. Now, the Division 296 release authority, the process is exactly the same as the Division 293 in that the ATO will issue the assessment to the individual, and at that point the individual can pay the ATO themselves, or they can elect to release it from the SMSF, in which case they log on into MyGov, or they can ask their personal accountant, and they elect to release the amount from super. The ATO will then issue a release authority to the SMSF, and the SMSF can then basically process that release authority, and the SMSF can pay the amount out of that bank account. What cannot happen, which we quite often see happening with Division 293 assessments, what cannot happen is the SMSF cannot directly pay the Division 296 because that is actually an illegal early release or if they haven't met a condition of release, it can be an illegal early release of super. So you do have to follow the same process. So you either pay it individually if you want to pay it personally, or you ask to release the amount from super. Now, just quickly, death and Division 296. It would be more convenient to die during 26-27, even up to the 30th of June 27. You will not be liable for Division 296 for any year. If you die on the 1st of July 2027 or later, your TSB will be set to nil from the date of death onwards. However, if your total super balance was greater than 3 million, for example, 4 million, at the start of the year of death, so for example, on the 1st of July 2027, there will still be a final assessment of Division 296 tax, which will go to the estate. Other important note, so any good advisor up until now has been using reversionary pensions. However, we just have to take into account now, because the government likes to change things around on us, that with Division 296, the beneficiary of a reversionary pension, basically the TSB of the reversionary pension will be included in their TSB on the date of death, which may then push them over the 3 million mark and may make them liable for Division 296. Now, the question would be, would a non-reversionary pension be any better? I mean, you're still going to end up with Division 296 tax. It's just going to push it out another year. So it's not going to, alleviate you from Division 296. It's just going to push it out one financial year. Also, we would be looking at, you just need to keep us informed, basically, as the advisor, because we would basically be looking at commuting back the other person's pension ASAP. But yes, it is something to bear in mind. My final thoughts. I listened to 2 days of this, like I said, and that was actually before the budget came out. But the modelling in that still shows that super is the best place to leave assets, even with this Division 296 tax. Hopefully, you've been able to see that it's, you have to have basically over 10 million and all not in pension phase for you to even get up towards 30% tax. So given that the government's push now is to have a minimum 30% tax outside of super, you're still going to be much better off even paying Division 296 to keep it in super. So, it's quite conceivable. If you started a pension with 1.6 million, which was the cap, on the 30th of June 2017, which was when that cap was, it could have grown to, say, 4 million, and all of that could be in pension phase and tax-free. So you're paying zero tax on that. And then you would only be paying, we go back to, yeah, there's this one. Yes, so that would be in the graded box down the bottom. So you'd pay nil tax on that. You could have 4 mil where you're paying nil tax. Then you would only be paying a proportion of the 15% tax. So it wouldn't even be 15%. So it's a very, very, very low amount of tax in proportion to taking that 4 million out and investing it outside of super when we've got such high marginal rates and also now such high capital gains tax where, we don't have the CGT discount anymore, and we don't have, we have this minimum 30%. So that's my thoughts on, leaving it in super, even with this Division 296. I don't see a strong case for pulling it out of super. I see a strong case for building your wealth within super. Now, these are my key takeaways. The action that you need to take before the 30th of June 2026. So in terms of the cost-based adjustment or the cost-based reset, get your valuations done, especially if you've got things like property, because you want to have a really good valuation at the 30th of June 2026. It's going to take into account the maximum value of your property, so that going forward, you've captured the maximum value at the 30th of June 2026, so that if that asset does grow, you're going to basically maximize that value in terms of minimizing what you're going to pay in Division 296 tax. And number 2, clean up your assets. So if you've got other assets on your balance sheet, because you don't want to have to adjust them down, can you get rid of them? Now, you may just decide you don't want to do anything about the cost-based adjustment, and that can also be a choice as well, because it can be too difficult. If you've got a big share portfolio, it may just not be an option, but it should be something that you've considered. So that's the 30th of June 2026. 30th of June 2027. Now, this is the key date for having balances either over or under 3 million. Now, if, say, you had a balance of 3.1, you may want to just keep it under 3 mil, just to keep yourself out of the Division 296 regime forever. So that's something to consider. So just keep that in the back of your mind for the 30th of June 2027. So that's if your member balance is over 3 mil. The other thing to consider is if you've got husband and wife, if one of you were to die, if you're going to be over 3 mil. So just keep that in mind as well. So they're basically my key takeaways. The only other thing I wanted to mention, just see, yeah, good, is the budget as well is going to change strategically what we do as well. So because with the capital gain, so with capital gains, outside of super, they've said from the 30th of June 2027, the discount is gone. There's no CGT discount. It's indexed, and then there's a minimum 30% tax that you're going to pay. So it's going to change our strategy a little bit, because what we routinely do is use, either your unused carry forward concessional amounts or a reserve strategy if you don't qualify for that, if your balance is over 500,000, to minimize the capital gain. But if you're going to pay a minimum of 30% tax, then that strategy is, we're not going to, use up concessional contributions for no reason if you're still going to pay 30% tax. So it's going to change the way that we do things a little bit. So also bear that in mind as well, because we've got until the 30th of June 2027. That's what I'm saying. Just bear in mind, we've got until the 30th of June 2027. If you're thinking about selling assets outside of super or moving them into super, because the 50% discount, you've only got until the 30th of June 2027 to make the maximum of that. And then after that, we start having to bring in these different rules. So that's another thing to keep in mind as well. So that's pretty much it for me. I've covered everything that I need to. I've given you all the decision making that you need, everything that you need to consider. I don't have any questions, which I hope is a good thing. So yeah, hopefully I have been able to communicate this in a clear manner, and everybody's understood everything. But yeah, they're the main things that you need to understand today. Just make sure that you get those valuations done. Decide what you're going to do about adjusting your assets down. Oh, hang on, I do have a question, but oh yes, that I should have mentioned that. Yes. So the question is, do I have other super outside of SMSF? Does this count? So yes, when we're talking about total super balance, we are talking about all of your super. So we as your advisors, we need to be aware of all of your super balances. So not just what's in your SMSF, but what's in your any other super that you have. So we do make an effort to ask you, for reports from time to time, so that we know when we're advising you what other super you have. But yeah, if you can also let us know if we're unaware of other super, because that does combine to make your total super balance. So yeah. If there's no other questions, I'm going to finish it there. And thank you very much for attending. And I will see you all soon. If you do have any other questions, you can email me. Hang on. Oh, so yeah, different ways you can connect with us. Got our Instagram page. Hopefully you're all subscribed to our newsletter. And we've got some webinars up on our YouTube page. And yep, there's the email there. Susan at susanoconnoraccounting.com.au. You can send me an email. And other than that, you can give me a call. So yeah, hope you enjoy the rest of the day, and I will talk to you all soon. Okay.